So yeah, this is Industrial Grade Investments, an empowered investor's blueprint to building wealth with industrial real estate. So I call this the overview presentation. This is actually a multi-part series, but I've kind of condensed it down into kind of a 30 or so minute presentation for today. So Adam gave me a nice introduction. Thank you, Adam. The only thing I probably want to add to that is, what we do at High Rise Capital is, provide insightful and educational content. And through that, we have several ebooks. And the third ebook, which is the Industrial Grade Investments, is actually the title of this presentation here. And it's formed the content for what's going to be covered here as well, too. And what we do at High Rise Capital, through our strong collaboration, we help clients achieve meaningful investment returns. And so how do we do that? So we've actually pioneered an empowered investor method or methodology, and it's a 5-step method, and I'm sharing it here with you today. This is actually going to be the basis for a future webinar as well, too, where we actually get into the 5 steps and actually talk about, the 5 E's that you see on the screen: ethos, educate, evaluate, execute, and empower. So I just kind of want to share that with you here real quickly. So let's get into it. So when retail investors invest in commercial real estate, what types of assets do they typically consider or think about? A lot of them think about or invest in multifamily. Some may get into office, retail. Some savvier ones probably invest in self-storage and mobile home parks. But how many of them actually consider these types of assets? And by these types, I'm referring to warehouses, manufacturing facilities, cold storage, data centers, multi-tenant facilities, fulfillment, last mile. All these various asset types are which would consist of industrial real estate. In order to understand industrial real estate, we really need to look at what the global supply chain is and how it actually works. And you'll find out, or you'll see later on in the presentation, how industrial real estate basically kind of fits into like the global supply chain and why it's so important to kind of have this as a foundation. So the supply chain is just a network between a company and suppliers to produce or distribute a product to an end consumer or buyer. And so when you hear the term logistics, you're just really referring to a specific link in that overall supply chain. And it involves the movement of materials, could be data, services from suppliers through manufacturing facilities, warehouses, and other distribution facilities to end consumers. And so supply chains, depending on how they're structured, they can be either local or global, depending on the relative distance between the supplier and the operating company. So globalization, which kind of originated in the 1970s and it accelerated for several decades thereafter, they've become more global and therefore increasingly longer. And so you may have heard of the term offshoring, and that basically refers to how a lot of goods and services are manufactured abroad, offshore from the United States in our case. So globalization results from the increased number of goods and services that essentially become tradable between various countries. And it's expanded to the point where goods are produced in the least costly parts of the world. And so global supply chains require logistics real estate, especially in key transportation nodes, to be successful. One of the major things that's going on in the industrial real estate space is the fourth industrial revolution. And so we've actually, in the manufacturing, let's say, sphere or world, there's been 4 major industrial revolutions. The first one began in 1960 with the invention of the steam engine. The second industrial revolution started around 1900 with the invention of the internal combustion engine. And the third industrial revolution, which started in the early 1960s with the implementation of computers and electronics and IT, and integrating all that into manufacturing processes. Now we are within the sphere of the fourth industrial revolution, which is also known as Industry 4.0. And it's basically built upon the third industrial revolution by way of computerization and digitization of everything that was in the prior revolution. So machines that are digitally connected and that communicate and share information with one another. And so that these decisions are now made without human involvement. And a key component of this is the industrial Internet of Things. You may have heard of the Internet of Things, which refers to all of the internet-enabled devices, for example, that you may have in your home, from your refrigerator, perhaps to your television, to other devices. And so these types of devices also can happen in terms of the connectedness, I should say, in the industrial world and industrial processes. And so the industrial Internet of Things is a key component to this Industry 4.0. And so it's a comprehensive and holistic approach to manufacturing, and it's whereby factories operate more efficiently and they improve their processes and also productivity. So what Industry 4.0 causes is prices of goods to drop, reduce operating costs, which support the growth of industrial real estate, and also supply chains will continue to evolve and become more effective and affect the locations and also the types of logistics real estate that we see. The rise of e-commerce is a major reason for why industrial real estate continues to grow. And so the retail industry has become increasingly digitized over the last decade as more and more people basically participate in online shopping, and a lot of that has replaced in-person shopping. So online shopping is just not a national, but it's really a global trend that's embraced by people of all ages. And over the last decade, global e-commerce sales have experienced double-digit growth on a year-over-year basis. So if you see here on the figure, you can see how that growth is taking place. And right here, it's just reflecting in terms of trillions of US dollars, major worldwide economies in terms of that growth that's taken place. And this is really reflective of overall percentage of total retail sales. And you can see the trajectory of how this has taken place over that last 10 years or so. So as part of the rise of e-commerce, consumers have near limitless access to goods and services that in some cases can be delivered within a day. Consumers have come to expect online shopping to provide benefits such as pricing or reduced pricing, increased speed, and also convenience over traditional shopping. And a lot of times this is just referred to as the anywhere and anytime. I can get whatever I want, whenever I want it, or at least order it, I should say. And so this has caused downward pressure on retail real estate due to the decreasing amount of in-store traffic that is now taking place. In order to kind of comprehend how much change is taking place as compared to retail and logistics real estate, Prologis research has actually shown that for each $1 billion in annual sales of e-commerce, they've actually estimated the difference in terms of the retail and the logistics footprint. So when you have a traditional retailer, for each $1 billion of annual sales, they would need about 2.5 million square feet of retail space and a little bit over or almost a third of a million of square feet of logistics space. A e-commerce retailer, and by I'm referring to exclusive only retailer on the e-commerce space, they would need about 1 million square feet of logistics space for distribution and fulfillment purposes. So you can see that an e-commerce retailer requires about 3 times the logistics space of a brick and mortar retailer, but it would still have an overall smaller real estate footprint. And so it essentially has a cost advantage over a traditional retailer. And this is also important because the rise of e-commerce has greatly increased the demand for industrial real estate, and this is a major reason why. So what does the industrial real estate market consist of? So it is actually the largest sector of our country's real estate in terms of footprint and also dollar value. And so it's approximately 25 billion square feet of industrial space in the US. And it's also the most diverse asset with a lot of sub-asset types. So you have warehouse distribution, and underneath that, there's some subcategories as well, like last mile and cold storage. There's manufacturing, there's flex space, there's data centers, and there's also multi-tenant facilities. And there's also some other niche assets as well too within the industrial space. Because of time constraints, we're only going to be covering the warehouse distribution, last mile, and manufacturing asset classes here. But when we do the multi-part series, we'll get into each one of these in more detail. So the warehouse distribution is about 55% of the total industrial real estate market. It's about 14 billion square feet of US warehouse space. It's about typically a minimum of about 50,000 square feet. And you'll usually find about a clear height in these buildings of about 16 feet. And there's usually some variable percentage between how much of it is used for warehouse or storage and actual for distribution activities. And it involves the movement of goods at high volume or perhaps high frequency. And a lot of this is facilitated by the use of trucks, mainly 18-wheelers. And this is very critical because a lot of these types of facilities tend to be located on or near major interstate highways, thoroughfares, or in close proximity to airports. They also utilize multiple loading docks on one or more sides to accommodate loading and unloading of multiple trucks at the same time. And in the US, most of these facilities have been exclusively single story, but that is starting to change. In land constrained cities throughout Asia and Europe, a lot of these actually are now multi-story type facilities just because of scarcity of footprint. A lot of next generation facilities are going to have larger storage capacity. So that can be done by way of either taller or clear heights and or larger footprints, or by utilizing multi-story facilities and also more technology like we covered under Industry 4.0. Last mile facilities are typically less than 100,000 square feet. They're the final leg of the supply chain, and they're located as close as possible to the end consumer to facilitate direct delivery. And they're typically located near the urban core. And so this tends to be problematic because, there's limited space inside the urban core. And when there is infill locations that can be used, they usually have incompatible zoning for warehouse use. So suitable urban properties are expected to become scarcer, especially as the demand for last mile facilities increases. Manufacturing facilities constitute about 30% of the total industrial real estate market, which is about 7 billion square feet of manufacturing space in the US. These types of facilities are typically custom built, and they have a high percentage of manufacturing space, and they also tend to have high power requirements as well based on all the equipment that's being used and the power requirements for the equipment inside these facilities. And they tend to be a blend of manufacturing, warehouse, and office spaces. So there is usually some storage that takes place in terms of like in the warehouse space of it. And of course, the manufacturing is where you find all the heavy equipment and of course, office space. So what have been the impacts of COVID-19 on the industrial real estate market? So there have been two major impacts. One has been the accelerated rise of e-commerce, and the second has been supply chain resiliency. So this was the graph that we saw a few minutes ago, and you can see how the trajectory of has actually been accelerated in terms of how much was been forecasted for 2020 and 2021. And so the COVID-induced lockdowns have spurred worldwide growth of online shopping. And the online shopping has also been the biggest catalyst for, like I mentioned, the continued growth of this sector. This graph here actually shows over a longer term, over the next 10 years or the next nine or 10 years, you can actually see what's been forecast in terms of the effect that COVID has had in terms of the e-commerce penetration. This one is specific to the US, while the previous graph that we looked at was actually based on multiple countries globally. So e-commerce activity increases the footprint of distribution facilities. Warehouse centers are typically located near large population centers, and these will become premium assets as companies look to secure competitive advantage in the e-commerce world. The heightened demand for faster delivery times has led to the growth of last mile facilities in urban areas. And as these last mile sites enable closer proximity to end consumers, and therefore they can accommodate, either same, 1 or 2 day shipping. And on the figure here, you can actually see the subscription growth for Amazon and how that has grown over the last 5 years in terms of a subscription to its Prime service. And you can actually then see on the right side of the figure here, how the actual click to door times are continuing to decrease. So basically customer expectation has gone to the point where people want things sooner and sooner and faster. And therefore logistics real estate and industrial real estate is accommodating that. So the other major effect has been with regard to supply chains and making them more resilient. A lot of companies are looking to short and diversify their supply chains. And how are they doing that? So one way that they're doing that is by reshoring and bringing manufacturing back to the United States. And another way that they're doing that is through nearshoring, which is bringing manufacturing back closer to maybe Canada or Mexico. Other companies are adopting a China plus one strategy where they're expanding manufacturing outside of China. Or what they're maybe doing is developing redundant key suppliers. And another thing that's being done is by increasing their safety inventory levels. If you remember during COVID or the early onset of COVID, store shelves were wiped out, warehouses were basically empty because so many people were buying and panic buying in a lot of cases. And so inventory levels a lot of companies are looking at increasing their inventory levels to kind of make up and to be more resilient in that matter. So what has been the historical performance of industrial real estate? Most people don't know that industrial actually has been the the best performing sector of commercial real estate for the last not only 10 years, but actually over the last 5, 3, and actually over the last year as well. And it's one that basically hasn't gotten a lot of attention, hence, today's presentation. The second best performing sector in commercial real estate has actually been senior housing. And it's funny because both industrial and senior housing both tend to get overlooked by many retail investors. And we're actually going to be doing a webinar series on senior housing as well too later this year. So what is the outlook for this sector? So pre-COVID, the industrial had a market vacancy of about 4.9%. The historic low was 4.8. Like we mentioned, it's been the best performing sector, and that's based on several different metrics. For example, net occupancy, rent growth, and also capital appreciation. The US economy is 70% based on consumer spending. And so it should be noted that any type of recession or lockdowns which affect consumers will also hurt businesses and also have an effect on industrial real estate. And there also may be some risk of oversupply in certain markets as well. So what has been the investor sentiment in this sector? So according to a 2020 investor sentiment that was conducted by NREI and NIC, respondents rated industrial at 7.4, and the highest rating of industrial, this has been the highest rating of industrial in the 7-year history of this survey. And if you see here, between 2014 and 2019, respondents rated industrial as one of the top 3 most attractive sectors, but finally, it's now gotten the attention of more investors, and it's actually the most attractive, I guess, if you want to call it, investment class in commercial real estate now. Another way of measuring investor sentiment is a study that was conducted by CBRE last year, and they looked at how investor preferences have actually changed by varying degrees over the global financial crisis, and then pre-COVID, and then present day. And if you see here in the middle of the figure, you can actually see industrial highlighted here in the red box, and you can see how industrial over each of these periods has actually increased in terms of investor preference. And you can see with apartment, there's been a slight drop off from 2019 to present day. Hotel and hospitality, of course, has dropped, office and retail. And I guess it's worth noting, especially, for cautious investors, I would say that when sentiment becomes too one-sided, that also can be a concern. So just something to kind of bear in mind if you're ever looking at investment opportunities in this space. The cap rate in the industrial sector, the aggregate cap rate, has actually been dropping since 2009. There's a healthy spread between the aggregate cap rate and the lending rate if you want to use the 10-year treasury note. And that's going to continue to kind of factor into the long-term demand for industrial assets. So just to kind of provide a little bit more kind of clarity, the spread that you see right here between the aggregate cap rate and the 10-year treasury, this is usually used as a measure of kind of quantifying kind of the risk to reward premium. And so someone investing industrial versus kind of holding a 10-year note, which is typically considered to be a risk-free investment, you can kind of see that you're taking a risk whenever you're investing in an investment like industrial or any type of investment. And so when you're looking at the risk premium as opposed to just holding a government note, you can see what that risk premium is right now. And so it's a healthy spread. And so by taking risk by investing in industrial, you're being rewarded with that. And that's essentially what's being shown here. And I guess it's also important to note too that holding a 10-year note, I would say, is not as risk-free as maybe a lot of people may want to say it is, because you're still subject to inflation risk. And we're going to get to that in a couple of minutes as well. So what is the likely direction of cap rates? So you probably don't do this, and I don't do this very often, but if you ever want to go look at the FOMC press conference, they released their statements. And so from a couple months back in December, it was pretty noteworthy, some comments that were made by the Fed chair, Jerome Powell. And I'll just read to you a couple of the statements. He said, there are significant disinflationary pressures around the world, and there have been for a while, and they persist today. It's not going to be easy to have inflation move up. And that's why we've adopted the flexible average inflation targeting framework. That's why we're aiming for an overshoot. And this overshoot, I think, is something that people need to realize, because before, the stated target in terms of inflation by the Fed has been about 2%. And what they're saying right here is that we may actually overshoot that. And I think you'll understand why that is in a few seconds. So we have more deficit spending and more government debt. So we've experienced a surge in deficit spending and projected US federal government debt. And this figure right here is actually from the Congressional Budget Office, or from the CBO. And so this is how they're projecting our national debt in terms of over the next 30 years. And you can see that low interest rates are essential for the debt service to be manageable when when deficit spending continues to add on to the national debt, and where the federal debt is actually projected moving forward over the next 30 years in comparison as a percentage of gross domestic product. We also have a lot more global negative yielding debt. And this is important because where are people going to find yield? So we hit an all-time high of $18 trillion just a couple months ago. And so you can see the surge in negative yielding debt that's taken place over the last couple of years. There's also more risk taking. And this graph here is basically a fund manager survey. But a lot of investors are actually taking more and more risks, especially at the retail level, because there's that constant need and that constant looking for yield in this low rate environment. And so people are taking on more and more risk. And a lot of that is actually fueled by speculation because of cheap money. And it's also driving up asset prices. So something to kind of be mindful of, in terms of investing or developing your investment thesis of how you're considering and how you're quantifying risk. We also have more inflation on the horizon. So these are the inflation expectations, and you can see where they started in the beginning part of the year 2020, and you can see where they've actually gone to. We've seen a surge in US inflation expectations, and this is the highest level since 2013. Commodity prices are also reflecting these expectations. Look at the price of precious metals, timber, copper, take copper, gold, silver, like I mentioned, and look at corn, soybeans, and wheat. And you can see how they're already being priced in, these expectations in terms of where inflation is headed. And the Fed has even signaled, we just saw that a few slides back, they're looking for an overshoot. And we don't even know how much of an overshoot they're looking for, but they know that the more they can inflate away the debt, the easier it is to manage the debt load. And therefore, it's also easier to take on more debt moving forward. So we have more money printing. The Fed wants more inflation and a near zero interest rate environment that will persist for perhaps many years. And these factors benefit hard assets, especially income producing ones in commercial real estate, such as industrial. So I'm going to ask a little quiz right now. So I don't know if anyone has ever heard this quote or who said this quote, but it's never underestimate the ability of central bankers to find ways of creating liquidity, inflating asset prices, and manipulating markets. If you guess me, then you'd be right. Where are we now, right? So we have trillions of dollars being injected into the financial system, right? We have investors seeking yield and seeking inflation hedging strategies, right? The Fed's inflation outlook is going to be to overshoot. And who knows how much that really is an overshoot by. And that's also taking into consideration that, the real metrics of CPI and so forth don't even accurately measure the real loss of purchasing power that we experienced. And that's going to be a subject of another multi-part series for later this year, where we get into all those details and kind of construct what's really going on a more macro level. And so that increased demand for high quality industrial real estate, I think it's fairly safe to expect that there's going to be a lot of longer term cap rate compression, not just in industrial, but in other asset classes in commercial real estate as well. So what are the takeaways from all this? So CBRE estimates that 1.5 billion square feet of additional industrial space will be needed by the end of 2025. And of course, the demand drivers are going to continue to be the increasing growth of e-commerce, onshoring and nearshoring of manufacturing facilities, of course, the fourth industrial revolution that we talked about, and the continual optimization and resiliency of supply chains. And we didn't really get into this in this presentation just because of time limits, but we're also going to experience higher inventory levels. And these higher inventory levels are also going to increase the need and the demand for more industrial assets moving forward. When you look at the top 100 largest transactions that took place last year, you can see that the average size was a little over 1 million square feet. And that was almost 200,000 square feet larger than the average transaction size that took place in 2019. So demand was strongest for facilities of 1 million square feet and larger. These are like mega distribution facilities. And so the top 4 out of the top 10 markets I've boxed in here in red, so you can kind of see geographically where they are. So number 1 is Atlanta. Number 2 is Pennsylvania, specifically the I-78, 81 corridor, DFW, and then of course Inland Empire here in California. So investors that are interested, what should they be focusing on? Well, I would say probably supply constrained and high barrier markets, assets priced at or below replacement costs, of course, looking at high quality tenants, and long-term leases that provide some downside protection in the case of any type of recession or market softening, and that would lead to an increase in market vacancy. And so if you look here in the table, these are actually 5-year rent growth projections, and some of these numbers are just phenomenal. You can see how the top 5 markets here, actually all in California. So you have Los Angeles, Oakland, Central Valley, Ventura, and Orange County. And the 5-year rent growth is projected to be well over 30%. And so what I've done here, I've actually boxed in the rent growth numbers that are all over 25%. I mean, these are just phenomenal numbers. And the national average is projected to be 21%. So there's a lot of markets out there that are going to do fairly well. But, again, investors have to look at at property specific assets and really kind of do their due diligence. But as a whole, this market is still projected, even with the last 10 years and how it's performed, it's still, there's still a lot more room to grow potentially. And so these conditions are highly favorable for risk-adjusted investment returns. And that is it. So I know that was a lot to kind of go through in a short amount of time. So if you're interested in learning more, we do have a free ebook on our website called More Doors, More Profits. And that is a link to our website on the screen here. And the content that this was based on was our ebook called Industrial Grade Investments. And of course, that'll be released shortly. And please watch out for the release of our upcoming podcast as well, too, called The Alternative Assets Show.